Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about variable annuities. So variable annuities are the fourth type of annuity that we're talking about here in our video series all about annuities. So if you haven't already, be sure to check out the links below in the description below this video and check out some of the other videos there in this series. So what is a variable annuity? Well, I think the best way to think of a variable annuity is to think of them a little bit like mutual funds. Only mutual funds that are held inside of a variable annuity are actually called sub-accounts. So that's an important distinction to make there. And there's a few considerations that I think you need to think about before getting into one of these variable annuities, and some things that I think you need to understand. So one of those is going to be the fees. And so fees are something that is probably one of the hot topics as it pertains to different annuities, and especially with variable annuities, because they tend to be the most expensive of the different types of annuities out there. And there's a few types of fees and expenses that you need to know about. One of those is something called M&E, or mortality and expense, and that could be 1% or more. It could even be close to 2% on some annuities. So make sure you understand and ask about what is that mortality and expense. The second type of fee that you might see, and we're going to talk about this in a lot more detail, but riders can oftentimes be added onto these variable annuities. Some of these riders come in the form of a death benefit, where they have some things that would happen, some guarantees that they would make if something happened to you. Some of them might be living benefits, some income benefits that could be paid on that. We're going to talk about that here in a moment. But those riders can be anywhere from 0.5% to 1%, 1.5%, and then you can even add multiple riders onto the same policy, which can really add up as well. And then the third type of fee that we want to look at is the fee for the sub-accounts. And that tends to average about 1%, more or less, but some can be a little bit more expensive and some can be a little bit cheaper. But the sub-accounts are going to be, again, those kind of mutual fund-like accounts that you can purchase within the variable annuity. And so each fund might have its own separate expense ratio, just like any other mutual fund that you might look at. Then there can also be some admin fees that could be added in there, and maybe even a contract fee where you have an annual cost of $50 or $100 just to have the annuity each year. So when you add all that up, it wouldn't be at all uncommon to see a variable annuity that has fees of 3%, sometimes well over 4%, even approaching 5% on some of these things. So one of the very important things that you want to make sure you understand is, are those fees worth it for the benefits that you think you're going to be receiving in return? Okay, so now let's talk about some of these benefits. So one of the benefits might be the fact that variable annuities, as well as all annuities, are tax deferred. And so what that means, essentially, is that any gains, any interest, any dividends that are paid on the investments within that variable annuity get deferred, and you don't actually pay taxes on that money until you pull that money out. Ideally after age 59.5, because again, annuities, variable annuities included in that, are retirement vehicles that are intended for retirement. So they get that 59.5 rule, just like most of the other IRA accounts and 401k plans that are out there. It's important to know, though, that if you're buying an annuity for the tax deferral, that you understand how those taxes are going to work. So they're going to actually be classified as a type of income known as ordinary income. And generally speaking, that's going to be the highest rate of income tax that you're going to pay. It's at your marginal tax bracket. And how it works essentially is that when you go to take those distributions, you're going to be taking out the gains first. So if you put $100,000 into the annuity and it's worth $120,000 and you want to take a $10,000 distribution, that's going to be 100% taxed at your ordinary income tax rates. And not until you've exhausted all those gains would it be considered a return of your principal. So that's going to be very important for you to understand. And one of the things we talk about in some of the other videos is you want to really make sure you know how the advantages potentially of that tax deferral is going to weigh out against some of the other options that you might have. So generally we like to see people maxing out their other types of savings like 401k plans or IRA accounts and Roth IRA accounts, and only if they've exhausted all those other retirement savings methods would an annuity potentially make sense. Because important to know, and we'll not talk about it too much here, but generally speaking, that unless you're in the very highest tax bracket, ordinary qualified dividends as well as long-term capital gains only get taxed at a rate of 15%. So if you're in a higher tax bracket, your ordinary income tax rate could be, up in the 20% or 30% range, so you could be paying potentially a lot more income on that. So you want to make sure that you understand that. One of the other types of benefits here that you might experience with an annuity, though, is going to come in some of the income features or withdrawal features that some of these annuities offer. And those basically fall into a category known as the living benefits. And so if you think about how an annuity works and how a variable annuity works, it generally is going to be an investment in these funds, and they could be funds that are very aggressive. They could be stock funds, they could be international, they could be very conservative investments that invest in bonds, like maybe treasury bonds and things like that. But the value of those investments is going to fluctuate over time depending on how the performance of those funds do. And remember, the other thing that we need to think about is not only how is the performance of those funds doing, but that performance minus all of those fees and expenses that we talked about here a little bit earlier. But a living benefit, like an income or withdrawal benefit, might say regardless of how those specific investments do, they're going to grow something that's oftentimes known as the benefit base. And that benefit base might grow at a fixed percentage. It might be simple interest. It might be compound interest. So that's an important thing that you need to understand how that interest is. But in here, we're going to use a hypothetical example, and we're going to say that in this case, they're going to grow that benefit base by 5% per year. So if we kind of attach some numbers to this, and let's say that you started off and you put $100,000 into an annuity, that benefit base, 5% compounded, is going to grow to $127,628. And that's just the simple math of $100,000 compounded at 5%. And so what that means is that regardless of what the value of those underlying investments are, even if the investments are worth $110,000, or let's say that those investments, they maybe didn't do anything, maybe they went down in value, maybe they were only worth $90,000. What that benefit base means is that $127,000 is going to be used to calculate your income. And how most of these annuities work is they're going to have kind of a tiered income schedule. And what that might look like is if you're under 60 years old, that might be 3.5%. And so what that means is if you turn on income at 59, let's say, or 57 years old, they're going to take basically 3.5% of that $127,000, and that's going to be what your income is going to be calculated on. Then they might say if you're between 60 and 64 years old, that might go up to 4.5%. And then if you are over 65, that might be 5.5%. So as you can see, if you're buying this for income, and you're probably buying this for income in your retirement, it probably, for most people watching this, it probably makes the most sense to turn that income stream on after age 65 because they're going to give you kind of the best return there. Some of them do have some other things where they say at age 70 or age 80, they might even pay a little bit more, maybe 6.5%, or possibly even a little bit better than that. But generally, our opinion of this is that we think that age 65 for most of these is kind of the sweet spot for that. So this would be under a situation would be a single life. They also most of these annuities offer the ability to have it as a joint life. And basically the way a lot of these work is that it's going to basically subtract 0.5% per year. Again, this is something that you want to make sure that any annuity that you're looking at, you understand that. So if you turn on that income at 65, but you wanted it to be guaranteed for either you or your spouse, that might drop down to 5% in this hypothetical example. Another thing that you need to think about here as well, though, is that it's going to be, if you do a joint benefit, it's going to be based off of the age of the younger spouse. So if you're 65 but your spouse is only 64 or 63, you're actually going to fall into this category right here. But again, you could just wait until your spouse or the younger of the two of you gets up to that 65, and then you could take that higher benefit. Okay, so a couple other things to think about here as we're talking about these types of living benefits. So one of those is we used, again, a very simple example here where that benefit base was going to grow by that 5% compounded each year. But some annuities will offer some lock-ins. Some of these will lock in on an annual basis, usually on the anniversary date of the contract. So if you started the contract on June 1st, it'll be every year on June 1st, they're going to take a look. And if one of those lock-in values was higher than where you started, certain annuities will grow that 5% or whatever that income base growth rate is. They're going to grow it off of that higher locked-in value. So something to think about. So some of those lock-ins can be annual, like we just talked about. Some of those could be monthly. And some of them could even be daily, where they're going to actually take a look, and every single day as it's maybe going up, they're going to lock that value in and then grow that benefit base compounded off of that. One other distinction to make here, though, too, as we're talking about living benefits, I wrote down income and withdrawal. As far as annuities are concerned, as far as variable annuities are concerned, these are two very different things here. So with the withdrawal benefit, that's oftentimes known as a GMWB, so guaranteed minimum withdrawal benefit. And generally, once that income is turned on, so in this case right here, that $127,000, if we're going to use that as an example here, would be about $7,019 per year of guaranteed income. So even if the value of that annuity dropped, or even if it continued to drop all the way to the point where maybe that annuity went to zero, in this case right here, as long as you're still alive, they're going to continue to pay that guaranteed minimum withdrawal benefit. And again, if you did it as a joint life, that number would be a little bit less, but that would be as long as either you or your spouse are alive, they're going to continue to pay that benefit. The other type of benefit that you see sometimes, and they're not quite as common as they used to be, so we're going to put GMWB, that's what we just talked about there, guaranteed minimum withdrawal benefit. And the other one is something called GMIB. And that's a guaranteed minimum income benefit, and that's going to work a little bit differently. So you might have something very similar in terms of how that benefit base is going to grow, and we'll just assume that's exactly the same as this. But the difference comes right here. What happens when that contract reaches zero with the GMIB is then you would be forced to annuitize that contract. And so what that means is that essentially you've taken enough withdrawals out of the policy and there's no money left in that, but they're going to go back up here to that benefit base, wherever that was locked in at, and now they're going to annuitize that. So that's going to be dependent on your age. It's going to be dependent on whether you do it as a single life or a joint life. Obviously, joint life is going to lower that, and generally the older you are, the higher that GMIB benefit is going to be, and the younger you are, the less that it's going to be, because it's, how much time does that annuity or insurance company have or think they are going to have to pay those benefits out. So you want to make sure that you understand a very important question to ask with not only this type of annuity, but any type of annuity is, what happens to my money when I die? Does my spouse get it? Do my kids get it? What things are actually guaranteed or not guaranteed? Very, very important things to understand there, but know whether you've got a GMIB or a GMWB if you're talking about a variable annuity. So the way to look at this, and we talked about some income features and some of the other types of annuities, the indexed annuity, and as well as the single premium immediate annuities and the deferred income annuities. So we want to always look at what are the baseline guarantees? So in this case right here, using this hypothetical example, and we said if you're, let's say 60 years old and you're planning on turning on that income at 65 out here, we know that regardless of how the performance of those investments go, that you're going to basically have at least that $7,019 a year of guaranteed income. And if you're thinking about this as a primary purpose of generating some income for your retirement, you want to compare and see how does that stack up against maybe what you could get in a fixed indexed annuity, or how would that compare to a SPIA, single premium immediate annuity. And again, there's going to be pros and the cons of each of those, but you want to understand what are those minimum guarantees there. And then the other thing you want to look at too is, what is the potential for growth in this? Because again, at the end of the day, this is still going to primarily be an investment account, and here where you can select different investments. So another important thing to think about here, or make sure you understand, is what are the investment options. So most of these annuities, variable annuities, are going to have a menu, and so that menu could be as little as maybe just a small handful of individual sub-accounts, maybe as few as 6 or 12. It could be as many as 50 or maybe even 100 in some cases, but you want to know what investment options are on there and look at the track record, look at the expenses of those funds, make sure you understand what that growth potential is. And then the last thing, or one of the last things that you want to understand, is what is the allocation that you're allowed to invest in within that menu. Because oftentimes if you're adding in one of these living benefits, they're going to put some restrictions on the asset allocation, and primarily they're going to limit the amount of money that you're able to have in some of those riskier funds like the stock funds or international, and they might tell you that you can only have, maybe in some cases maybe 10% or 20% in those aggressive funds, and then most of the money has to be in bonds or safer things. So understand what that allocation is going to be. And then some of the funds, some of the variable annuities will have an automatic rebalancing. And so what that is that, and you want to understand how that works as well, but you want to understand, is there a time when if the value of these funds drop a little bit because they're making these guarantees, some annuities, some variable annuities will automatically shift you into a more conservative asset allocation. Sometimes that's a good thing. Sometimes that's because maybe the market is going to be pretty volatile, and they're doing that not only to protect the annuity company, insurance company, but they're also doing it to kind of protect your investment as well. But you want to understand how that money movement works, and is there a automatic feature where they're going to do some rebalancing and move you into an area that maybe you didn't really want. Maybe you wanted to be a little bit more heavy into stocks. So those are some of the things there. So one last thing as we wrap up talking about variable annuities is we want to talk a little bit about the death benefits that some of these annuities have. And again, these are going to be primarily as another rider. But certain variable annuities do offer the opportunity to put a death benefit on. And how that's going to generally work is it's going to give you something maybe somewhat similar to what we talked about there with the living benefits, where it's going to have a minimum guaranteed rate of growth. It could be 5%, could be 6%, and then that's going to pay out based on that compounded growth of that death benefit. That's going to pay out to your beneficiaries when you die. One thing to keep in mind though on that is that oftentimes what we see with these death benefits is that they'll only compound that to a certain age. Maybe it's 80 years old. And so what that means is that you might add one of these death benefit riders on. It might be compounding the death benefit at 5% per year, but that 5% compounding stops at age 80. So even, you might live to hopefully 90 or 95 or 100, and so whatever that number got up to at age 80, and you can kind of pre-calculate that, that'll tell you what that death benefit is. And you might have that just kind of sitting there almost as a dead asset there. And so you want to make sure you understand, how does that death benefit, does it make sense? And especially given what some of those costs might be to get that annuity and to add that death benefit on there. So that's it. So variable annuities, so we talked about the fees, so make sure that you ask about those fees, you understand all the different options there. One of the benefits of an annuity is that you could put on one of the additional riders, an income rider or a withdrawal rider. We talked about that and how that could maybe fit in with some of the potential gaps that you might have in your retirement plan to provide some of that income. Death benefit is another option. Some certain variable annuities might offer long-term care, and they might offer other riders that you want to make sure that you understand how all of those different things work. So generally, I'm not necessarily a big fan of some of those other riders. Even the death benefit, I think in very rare circumstances makes sense. So there you have it. There's variable annuities. I hope you got some great information out of the video. Again, be sure to check out some of the other videos here in the series where we're going to get into a lot more in-depth discussion about the other types of annuities, some of the questions that you need to ask before buying one of those. And again, if you like what we're doing here, don't forget to hit that like or subscribe button and share the video with your friends on social media. And I'll see you back in one of my next videos. Thanks. Have a great day.